Hi, Paul here. Recently, my partner and friend, Don, and I sat and talked about what we think is one of the neatest things that he and I have ever done together. We call it the Stone Barn Equity Index. It's a very simple investment strategy that trades infrequently, on average, once a year, and offers a way to get reasonable returns with a lot less volatility than an unmanaged portfolio. We think it's a good option for um, small investors, even large investors, although large investors can get access to even some more sophisticated things that we do. It's cost effective. It won't cost you much to trade. Um, and we spent some time talking about it and explaining the benefits of it and why it worked. And you stick with us right after our little opening thing here. We'll get right to it. Don, a long time ago, when we kind of set out together to pursue a vision for, what would be the perfect ways to invest, perfect portfolios, that we could put together, given our combined years of investment experience and our our combined uh, review of all the mistakes that we've made over the years, and trying to avoid those. One of the things that we said was, you know, the small investor is underserved, and there's a good reason for that, and it's because the small investor actually costs more for a professional money manager to work with than than he can make. So small investors are typically loss leaders for investment advisors. It's a terrible thing in the industry, but it's true. But people that need the help most don't get it. Now we've had the rise of robo advisors, which tend to be very, very inexpensive. Um, but frankly, you and I have looked at several of those, and we haven't really found anything that, even though it meets it from the objective of from a cost standpoint, doesn't really meet it from a risk management and a performance standpoint. And that led us to work really hard over the past few years to um, consider all the possible investment vehicles that are out there. There's stocks, there's exchange traded funds, which are funds that trade like stocks. There are mutual funds. There's all kinds of there are variable annuities, which have, essentially what are mutual funds wrapped up in an insurance product. And all of those have advantages and disadvantages. And you and I decided that we put our brains to work. And I think the sad thing is it took us 3 years to finalize.
It's pretty simple, Paul.
That's right. And we came up with what we think is an extremely efficient and simple approach for smaller investors. By that we mean folks with more than $10,000, to get started, and but probably less than $100,000. Where if you've got that much money in an account, you can probably afford to pay a little bit more for some even better management. So we came up with the Stone Barn Equity Index. And what I'm going to do, if it's okay with you, is I'm going to bring up a little PowerPoint presentation. You've seen this already, and I'm going to try to ask you to comment on some of the things that we're going to take a look at here. Is that all right with you?
Fire away.
All right. I'm sharing my screen, and hopefully you can see this now. And this is a look at two different equity lines. What are we looking at here?
First off, the green line is just 4 exchange traded funds. Basically, in the picture as it's seen, we call it, it's unmanaged, just buying 4 ETFs. And as you can see, it's pretty good.
Yeah.
Over the last 20 years or so. It actually beats the S&P index, which very few mutual funds and ETFs over that course of time, and it beats it pretty soundly.
Mm-hmm.
But I happen to know that just by adding a couple of little twists. Now, let me regress just 1 second.
Yeah.
The small investor to me is just as important as the large investor. And we're bringing something to you right now that doesn't cost much. It's simple in design. You don't have to know all these things. All you need to do is to get our monthly update, and if there's no action, don't worry about it for a month. And so we're bringing, let's see, in Georgia we call it, we're bringing a hatchet to a knife fight. So we're bringing something that's really, really useful. Anyway,
Yeah.
so this is our unmanaged index. Now let's take a little peek at the next one, which will be a managed index, and just take a look at it. I know that you straightened that line out just a little bit. Can you go back one time? Let's just take a look at the previous slide. Notice that period of time right in there. There's quite a bit of pain in there, and we have taken that out with some of our decision processes that we only do this about average of once a year. We will make a tactical decision, and it will come when we have these very disconcerting losses that go on into the market. Unfortunately, we've been on a tear over the last 10, 12 years, and the market's up big. And but I happen to know, if you study history, we've got a few of these ahead of us in our lifetime. So
Yeah,
this is something that, from a tactical standpoint, this is a managed index. This is what we're handing off to you for a small amount of money per month, and it will deal with the most traumatic parts of the things that the stock markets that can pass out to you.
Yeah. Let's talk a little bit about some of the things that are in play here that make this attractive. The one is it's 4 ETFs. So it's not a huge portfolio. It's not hard to manage. It's not difficult to rebalance. That rebalancing is a second factor that plays a big part in this. This is extremely important, especially in the market is so volatile like this. Rebalancing once a month. Now, when we say rebalance, what we're saying is once a month, you get an email from us that says, look, you're going to stay the course, hold what you're holding, but we want you to review your portfolio. And, let's say that 10% is allocated to a given ETF. That's our recommendation. If your portfolio has more or less than of that by 5%, we're going to suggest you rebalance your portfolio. Otherwise, you're not going to touch it. And I can tell you that in this period here, there was nothing to do to the portfolio for about 3 years. You just didn't. All you had to do was once a month look at it, and you didn't even have to trade. You didn't have to do anything. You didn't have to rebalance. Everything stayed pretty much exactly where it needed to be. Now, in here, down in this area, that rebalancing became very important, and you would have been rebalancing monthly. Now, how long does that take? Anywhere from 10 to 30 minutes, depending on how familiar you are with your account software. This tactical move is where we say, there are some times where it's best to go fishing. You really just shouldn't be working at the moment. You're fighting uphill. So what you should be doing is sitting aside and not trying to make money when the winds are against you like this. And so what we do is, on average, not every year, but on average, we're going to suggest that you sell one position and buy another, on average once a year. That's all that there is. Now, another thing that makes this work is that you'll see that because we do these things, we capture about 95% of the market monthly increase when the S&P 500 is up. So we only get 45% of monthly market decrease in months when the S&P 500 is down. When you put these things together, you can see this capturing most of the monthly increase of the market in months when the market's up. You can also see us getting less than half of the decrease when the S&P 500 is down. These are called capture ratios. And when you put these things together, especially in You look in here in 2011, the market had a dip like this, and you can see that there was very little capture of that within the portfolio. That's an important part of what makes this managed index work. And what I'll go back to is one of the things that you kept us focused on when we were trying to create this thing was it had to be simple, it had to be cost efficient, and it had to be easy to implement. And I think we've got everything that we set out to do built into this. We're calling it the Stone Barn Equity Index. And you know, another picture that's going to be helpful is that drawdown picture. Do you want to take a look at that, Don?
Fire away.
All right, what are we looking at here?
Okay, the red line is basically the corrective actions that occur in the marketplace, meaning that they go down significantly. I think that where your area is, it's like 56% down.
That's right.
Blue
Yeah, right.
line is what our portfolio is going down.
Right.
And it's just a picture of the kind of volatility that we bring to a managed account. We don't have to go through all those valleys that are out there. In fact, we know a little bit about ducking around them, and we've had probably as good of experience as anybody I know at dealing with it. And if you're close to retirement or if you're just building your account, it's just as important. It doesn't matter. And this is the Stone Barn portfolio that absolutely is pertinent for small investors, large investors, but really the small investor who is targeted here because it's simple, easy to trade. Very limited number of decisions that you make over the course of years, several years in fact.
That's right. I'm going to go back to that first slide, this unmanaged index. When I talk to folks, I ask them, you know, now how are you managing your retirement account, or what are you doing with your IRA? And a lot of folks tell me that they're using mutual funds that are supposed to be diversified. And you and I are big believers in diversification. We know that the math of diversification is absolute. And we also find an awful lot of folks telling us that they're investing in target date funds. You know, I plan to retire at in 2050 or something like that. And so I put my money into a 2050 fund. Between now and the time I retire, the fund company gradually moves more and more of the portfolio into bonds or to fixed income or something less volatile. But in the early years, it's more focused on equity. Well, every one of those target date funds and almost every diversified portfolio that I have looked at looks exactly like this green line. And the problem with diversified portfolios is that while they do protect against you know, these catastrophic losses like we saw in 2008 and 9 and earlier in 2001 and 2, they don't protect well. You know, the loss from this point to this point in a diversified portfolio was somewhere in the 28 to 33% of your portfolio.
Absolutely.
That's hard to lose a third of your money and think about how am I ever going to get that back. The other thing that happens is in most portfolios, this one's a little different. Even though it's unmanaged, it tends to do really well during these up markets. Diversified portfolios tend to underperform in up markets. It's because they're diversified and they're not keeping up on the equity side. So we think if currently you're using a target date fund or you're in a diversified portfolio, we would suggest that you consider that maybe you want to look at something like this. Would it be worth 10 to 30 minutes a month, 10 to 20 minutes a month to make slight adjustments to your allocations in your portfolio to get something like this rather than something like that? And we can tell you that the difference in performance over that time is remarkable too. So
yes,
you know, even though these kind of look like the same thing, this greatly outperformed the unmanaged index, and it does it for the reasons that we mentioned, especially the way it's designed. It makes this work here. So what do we say then? Well, we suggest that you go to our website at stonebarnportfolios.com. We're still building it, so don't be surprised if you see some text on there that looks like Latin. That's just placeholding text while we get some other stuff in there. But you can find more information on the Stone Barn Index. And if you're interested, what we do is we suggest you watch us for a while. There's a little sign-up sheet there. Send us your email, and once a week you'll be able to track how our Stone Barn Index is doing, and whether it's keeping the investors out of trouble, or whether it's really accomplishing what you hope. And you can see without any commitment or any cost to you whether or not it's something that you'd like to pursue. You can watch it real time, as long as you want. We'll just keep sending you those updates. So what do you think, Don?
I think it's a good
I'm pretty pleased with this index.
I really think that very few people can beat the S&P. We can actually do it with an unmanaged index, but when you add management to it, you have a better opportunity to accomplish your goals, which in some cases may be anything from funding education for your kids to retirement to whatever it is to have an objective. And no account is too small. We think that this serves a place that needs professional attention, and you get it for a cheap price.
Yeah, that's absolutely right. All righty. Well, I appreciate you putting together that PowerPoint for us. We didn't say it at the outset, but Don did all the work at putting those pictures together for us to look at. And I think it told the story very, very well. Of course, if anyone has any questions, they can drop us a note, and the best way to do that is on our site, stonebarnportfolios.com. Go on there and fill out a contact form, ask us any questions you want. Happy to talk to you. Don, I'm going to run. I got some programming to do today, and I better get to it.
Yes, sir.
All right. Good to see you, my friend. Talk to you soon.
Bye-bye.